In today's episode of Saving Yourself from Wall Street, we're going to talk with John Rotonti, who is the manager of the industrial and infrastructure portfolio at Bastion Fiduciary. Before joining Bastion, John actually worked for almost 9 years at the Motley Fool, where he was a senior analyst, the head of their investor training and development, and he was a lead stock picker for one of their managed portfolios. Before the Fool, John got his master's in business administration from the Freeman School of Business at Tulane University. And he's also an author, having written a book, A Manual on Common Stock Investing. John's featured on all kinds of investing podcasts and actually has one of his own through us at Bastion called Rebellious Allocations. So with that, here comes John. All right. Well, thanks, John. I appreciate you taking some time out of your day to chat with me.
I'm glad to be here, Kirk. Thank you.
Yeah. I just wanted to sort of introduce you to everybody. And you've got a really unique background. And you and I actually share a little bit of that with our time at the Motley Fool. But can you kind of let folks know, how did you get to the point where you're working at Bastion?
Yeah, sure. So I started learning about investing as a freshman in college. I went away to college, University of Richmond in Virginia, my first time away from home, and found out pretty early on into my freshman year that my parents had gotten into some financial trouble, and it was pretty deep. And I was completely unaware of it because they sheltered me and my two sisters. And so I wanted to figure out a way to help. And so I went to the library and I tried to learn about investing or trading at the time, whatever it was, whatever books I could get my hands on. And I eventually came across Peter Lynch's One Up on Wall Street.
Okay.
I read the book in 2 days and it changed my life. It literally changed the trajectory of my life. I had an epiphany, one of the only epiphanies I've had in my almost 45 years of life now. And the first epiphany was I understand what he was writing about. He talked about some basic financial ratios, some basic stock concepts, and it all made sense to me, even though prior to reading that book, I did not know what a stock was, Kirk. Did not even know what a stock was. I was 18 years old, but it all made sense to me. That was the first realization. And the second one was, this is what I want to do for the rest of my life. I was just completely enthralled. And I became obsessed. I read everything I could get my hands on at the time. I eventually came across, Warren Buffett's letters on the Berkshire Hathaway website, started to read those, eventually got my hands on Warren Buffett's partnership letters. Before he actually acquired Berkshire Hathaway, he had a hedge fund. And so I got my hands on those and read those letters. And, Buffett said he advised people to start reading about businesses. And so that's where I took my educational journey next. I started to study businesses, and I haven't really stopped studying about markets, investing in businesses since then. And, I graduated from college and went to work for the family business for a while, which was hospitality, restaurants, and a small hotel in the French Quarter in New Orleans. But while I was doing that, stocks were always on my mind. I couldn't commit myself to the family business. It wasn't in my heart. It wasn't what I wanted to do. So I went back, I got my MBA at Tulane and, went up to New York, spent 5 years in New York working, eventually made my way, to the Motley Fool.
And what did you do in New York?
I started in New York selling institutional equity research. So I was institutional equity salesman. And so I spent my day calling on mutual funds, hedge funds, pension funds, trying to get them to buy our small cap research. I worked for a firm that published research reports on smaller and medium-sized public companies,
Okay.
and learned a lot about a lot of businesses. It's interesting when you're an analyst. on Wall Street, and I have a lot of respect for analysts, but they cover 15 or 20 companies in a sector or in an industry, and they become a specialist in that industry or sector. As a salesman, though, we covered 500 different stocks across all industries and all sectors. As a salesman, I had to be able to talk somewhat intelligently about any of those stocks that my clients wanted to talk about. And so it was an extremely educational position because I was exposed to 500 different small businesses that otherwise would not have been exposed to, quite honestly, because I was really focused on larger cap companies at the time. So I learned about just a ton of businesses across a wide range of industries. But more importantly, I think to the trajectory of my career as I started to build this network, because my job was to cold call fund managers, portfolio managers, and try to build relationships with them. And some of the relationships that I built back in that was 2011 and 12, I still have to this day, and those relationships are still going strong to this day. Um, from there, I became the first research fellow at the Gabelli Center for Global Security Analysis at Fordham University up in New York. So Mario Gabelli, really famous value
Yeah.
investor from Gamco and Gabelli funds. His undergrad university was Fordham, and so he was a Fordham alum, huge fan of the school, and he gave a lot of money to um, build a brand new business school building, but also to implement a value investing curriculum at the school. And so I helped build that program, that value investing curriculum program, um, working under Professor Jim Kelly, who was the director of the program. We became very close. I eventually wrote a book, published a book in December of 2013 called A Manual on Common Stocks Investing. I wrote it for the most beginning investor. So I had like my sisters in mind who knew nothing about stocks or markets, but had some money to invest. And so I literally start with, what is a stock? What is a bond? The most basic things. What are earnings? What is net income? Um, and the book was okay. Um, I've learned a lot since then. If I was to write a book today, I think it would definitely be different, and I hope better than the one that I published back in 2013. However, the book opened a lot of doors for me because when you're applying to jobs, um, it's pretty unique, I think, to say that you have a published book and that you can buy it on Amazon and
Yeah.
stuff like that. And so, yeah, I think that the book helped me get my job at the Motley Fool, among other things. And I started the Motley Fool in 2014. Um, as a junior analyst. I was at the Motley Fool for almost 9 years. Worked my way up to senior analyst, and then once you're a senior analyst, they had levels. So I was a level 3 senior analyst, which is as high as you can go. It's just like a
Okay.
seniority position. But I think more importantly, Kirk, is I became the head of investor training and development at the Motley Fool, and at the position that I held for like 5 years. Um, and in that role, I had three main responsibilities. I trained all of our new analysts, or at least helped train all the new analysts. Some other um, members of the investing team taught some of the classes for sure. But I was the head of that program and sort of coordinated everything and did most of the teaching. The second role was I acted as a resource to the whole investing team, not just to new hires. So if anyone on the team needed help researching something, trying to build a model, trying to come up with a list of questions to ask management, um, just anything that I could try to help with or try to find out an answer for them if I didn't know the answer myself. So I acted as a resource to the team. And then the third thing was I networked on behalf of the investing team to bring in outside experts to teach, to give us guest lectures in almost like a continuing education program. So, I brought in outside speakers like Michael Mauboussin and Aswat Damodaran and a lot of professional portfolio managers. And then left the Motley Fool and started my own podcast, The J Rowe Show, which just interviewed portfolio managers on their investing process and philosophy. I didn't ask them anything about their favorite stocks or anything like that. I wanted to know what it was like to work as an analyst or a portfolio manager at these different firms. Very detailed. So my questions were like, how many stocks does an analyst cover? How often do they travel for work? Do they attend conferences? How often do they speak with management? When they provide a deliverable, when they make a stock pitch to the investing team, what does their deliverable look like? Is it just a write-up, or do they attach a model? Do they attach a PowerPoint slide deck? Like the nitty-gritty details. If you were a fly on a wall or pull back the curtains on what it's like to be an analyst and a PM at these firms, those were the types of questions I asked. And the last thing I'll say about my journey is, um, the founder and CEO of Bastion Fiduciary, Cale Smith, he listened to my very first episode. He came across that episode that I did with Bill Nygren, who's the chief investment officer at Harris Oak Mark, and he emailed me. Cale emailed me, and we started just communicating about stocks and stuff like that, and building a relationship, and I think eventually a friendship. And it was really just like a 6-month courtship. I don't remember him early on ever saying, I'd like to think about bringing you onto the team or anything like that. It was just a communication back and forth, not only over emails, but over Zooms and over the phone. And then he visited me here in New Orleans. And then eventually he offered me a job. And so I'm a portfolio manager at Bastion Fiduciary, and I manage the Bastion Industrials and Infrastructure portfolio.
Okay. So before we jump into that part, I just want a couple of questions on your past. So when you went up to the University of Richmond, did you switch majors after your breakthrough? I mean, did you go in like medicine pre-med and then switch to finance, or?
It's a good question. I didn't. I took a bunch of business classes. So I took like microecon and macroecon and accounting 101 and accounting 102 and business statistics and intro to marketing, and I took all these business classes. But at the time, I also had a passion for political science.
Okay.
I remember being obsessed with that TV show, The West Wing, at the time,
Okay.
like obsessed. And I was like, I want to work in the White House. I want to work on campaigns. And so I got my degree in political science. I also, my freshman year, took some political science classes and became really enamored and friends with a lot of the professors in the political science department. And several of those professors taught like 3 classes. And so I was like, I definitely want to take all 3 of their classes. And yeah, so there was like 3 professors, I think, where I took 3 classes. So, 9 of my political science classes came from 3 professors because I liked them so much. So my degree was in political science.
Okay.
I took a lot of business classes, but then I went to get my MBA at Tulane.
Okay. All right. Yeah, it's funny. I was also a government major at the Coast Guard Academy, but it seemed like the more I dealt with politicians or government folks, the more I was like, I don't, I don't like these people. I don't trust them.
That's exactly what happened to me. So
Yeah.
I skipped over this part because it was such a short, part of the journey. But right when I first got out of college, before I went to work for the family business, I worked on 2 campaigns here in Louisiana: a mayoral campaign for the city of New Orleans and a gubernatorial campaign for the state of Louisiana. And great candidates, but didn't like the whole process of campaigning and politicking. I was more interested in policy and
Yeah.
like actual governing and governance, but the whole campaigning turned me off. And so then I went to work for the family, realized I didn't want to do that. All I could think about was stocks, and so went back to business school.
Okay. And then another question as you were talking, so you've got your J-Row podcast, you're hearing about numerous procedures as far as how to manage money. Did that help, or did that actually, do you find it sort of convoluted, maybe your process? Or did you find that you really did improve your investing process through those interviews?
I definitely, tried to adopt some of the best practices. I would say that, 85 to 90% of my process had already been built out. I'd been investing for a long time by then. So I launched the JRO show sort of mid 2023. Um, and I'd been investing for 20 years by then, pretty much, or close to it. And over those 20 years, my process definitely adapted and changed and evolved over time as I continued to learn more, um, and learn more about myself, my own sort of risk tolerance, my own emotional sort of fortitude, what I was good at and what I wasn't good at when it came to, there's lots of skills and tools that you can use in investing. Um, I learned that I was much better at, identifying what I believe to be quality businesses with you know wide moats and competitive advantages. I was much less good at like trading and more short-term thinking and trying to time the market and things like that. So over time, I learned what I was good at and what I wasn't good at, and I framed that process as well as the investing philosophy. Um, and then when I got to the JRO show, I definitely, picked and choose little things from all of the interviews and tried to add them to my process. But I would say the core base of the process had already been formed. Um, I've done martial arts on and off throughout my life. Haven't done them in several years, but two of the martial arts that I'm sort of most enamored with was Bruce Lee's Jeet Kune Do and then Krav Maga from Israel. And both of those um, martial arts sort of adopt best practices from other martial arts.
Mm-hmm.
Very, very little of it is just original and brand new and invention. They just took what they believe to be the best from each of those, from a variety of different martial arts, and packed it all into this new art called either Jeet Kune Do or Krav Maga. And that's what I've done with my process over time. I didn't invent anything. I just, copied and stole from the greats.
Okay. And we'll jump into that, sort of your philosophies in a second. Just want to take a second to have you kind of explain. So for Bastion, you're managing the Industrials and Infrastructure Fund. And, when I first met you, when I heard that, I had a very narrow view of what that was. But can you kind of explain in general what your fund is all about?
Yeah, so the Bastion Industrials and Infrastructure model portfolio is a domestic only, um, concentrated, and so by concentrated I mean about 25 stocks, uh, long-term focused, low turnover portfolio. So at a very high level, I try to identify what I believe to be the highest quality industrial technology and infrastructure companies based in the US, and then wait until I think they're trading at reasonable valuations. And when they're trading at reasonable valuations, I buy them. And then I just monitor the progress of the business and the management team. And as long as the underlying fundamental value of the business is growing over time, some businesses their intrinsic values grow faster than others. But as long as the fundamental value of the business is growing over time, as long as management is doing well by share owners, um, and the valuation doesn't balloon outside a zone of reasonableness, I hold. And the reason I hold the stock is because um, the math of compounding takes a really long time until it hits the exponential growth phase. Um, a lot of people have heard that 95% of Warren Buffett's wealth came after the age of 65, even though he started investing as a teenager. And it's because the way the math of investing works and an exponential curve, what it looks like is you make money slowly for about 30 years, actually. If we're assuming a market rate of return of 10%, you make money slowly for about 30 years, but then at around year 30, magic happens and exponential growth kicks in. And so that's why I try to hold for a really long time. As long as I find businesses that I believe to be really high quality, run by management teams that I believe to be exceptional, I'm going to get some of this wrong, but I believe that they are this way. I try to hold them with an iron fist. And then as far as industrial and infrastructure, yeah, I think that I have a um, pretty wide and broad view of what I include under industrials and infrastructure. And so in the portfolio now, we have everything from um, hyperscalers, companies building out these massive AI data centers, because that's obviously infrastructure, to physical assets. We have we have the electrical and um, power components that go into a data center. So everything from anything that you can imagine. I mean, little tiny interconnects and sensors, copper wires, fiber optic wires and cabling, um, the actual GPUs and other um, AI chips that actually power the data center, the actual compute of the data center. And then these chips, they sit in these server racks. So there's companies that make the server racks. Um, the chips are packed so densely together that they need to be cooled in a certain way. It's direct to chip liquid cooling. So companies that make the liquid cooling technology, we can go on and on. And then in the mechanical room, that's in the compute room of these data centers. In the mechanical room, you have all the air cooling, HVAC. You have uninterrupted power supplies, backup battery supplies, backup generation. I mean, on and on and on. Then to the data center, you have to bring power. So there's a lot of companies that we own that are related to the electrical grid and power generation or transmission and distribution. Beyond that, we have more just traditional industrial companies, manufacturing companies, transportation companies like railroads or trucks, anything housing related, Kirk. So not just home builders, but companies that supply the building materials to the home builders, companies that provide home services like plumbing, pool maintenance, pest control, on and on and on. And so, there's some retailers like home improvement retailers, for example. Um, there are pure play tech companies that I mentioned, the hyperscalers, the mega cap tech companies is probably another name for the hyperscalers, but there are pure play tech companies that have a lot of physical assets in the ground, a lot of infrastructure in the ground that help to power their technology. So like payment processors, they have millions and millions of route miles of telecommunications infrastructure that powers the payment, their payment loops around the world, that powers their payment rail systems, basically. And so it's, I think, pretty diversified portfolio for a lot of different clients.
Yeah, so when I first heard it, I think, it was just that general way we peg things into 10 sectors. I heard industrial, okay, I'm thinking big manufacturing companies, and then infrastructure would be getting it from point A to point B, but it's so much deeper. Uh, your definition is so much deeper than what most people would probably instinctively think.
I think so. I mean, that's the hope. And there's lots of companies that are on the watch list that are not yet in the portfolio that operate, that broaden that even more. There's cell tower companies. I don't have a cell tower company in the portfolio right now. Um, there are software companies that make, industrial specific software for like supply chain management, or to, software that runs a factory floor, operations software like that. That's not in the portfolio yet. So over time, I'm going to broaden it out even more. Aerospace and defense. I have a lot of companies in the portfolio. I don't know, a lot's probably not the right word. I have several companies in the portfolio that have exposure to aerospace and defense. So, these are what I call multi-industrial, or, you know, heavily diversified industrials that sell into multiple verticals, like 6 to 12 different verticals. And those verticals could be, manufacturing, automotive, healthcare, aerospace and defense, telecommunications and data centers, and on and on. Um, and so, I have several companies that, maybe generate 15% of their revenue or 20% of their revenue from aerospace and defense, for example. But I don't have any pure play aerospace and defense companies. That would also fall under industrials and infrastructure by my definition. So there's time, you know, there's ways for me to broaden it out even more, the portfolio even more over time.
Okay. Well, if you're only kind of focused on 25 generally, how do you go about kind of figuring out which ones sort of make your initial screening, and like how many do you monitor at any one time? I
Yeah,
mean, are there 100 stocks you're watching but only 25 invested?
it's a
Is
really
that
good question. So um, I think that one of the most valuable um, services that I provide my clients is whittling down my investable universe to only what I believe to be the highest quality, most exceptionally managed businesses that I can find. Um, and so I have cut out almost everything. Over, and this is not just since I've been at Bastion. I've been building this watch list or this investing universe for decades now. I've been following many of these companies for 10 or 20 years. Um, and so to answer your question specifically, I have an investing universe of about 50 or 60 stocks, and that's it. And so those are the stocks that I'm willing to put into the portfolio. And right now, about half of that is in the portfolio, 25 of the 50 or so. Um, and I'm not aggressively adding stocks to that broader universe of 50 because the criteria to get into that universe are so high, right? And so, like I said, 90% of what I initially start researching, I throw out within the first hour, Kirk, within the first hour. And so I do believe that's one of the most valuable services I provide because I think that one of the best risk mitigation tools for long-term minded stock investors is to invest in quality businesses because quality businesses have growing intrinsic values. The underlying value of the business grows over time. That's like, I think, a pretty common definition of quality versus some businesses have shrinking intrinsic values over time. Some businesses are powered by long-term tailwinds. They are growing organically or they're growing through smart acquisitions, and they are profitable and they have a long duration stream of profitable growth. They have a long runway of profitable growth ahead of them, and then they have good, cash conversions such that they are able to convert those profits into actual free cash flow, which is what we get as owners. A lot of businesses don't have those. Most businesses don't have those qualities. A lot of businesses face tailwinds. They don't have widening moats. They have deteriorating moats. They have fundamentals that are deteriorating. And because of the deteriorating fundamentals, their intrinsic values are actually shrinking. For companies that have shrinking intrinsic values, or even intrinsic values that are not growing, just sort of stable, there's not a lot of cushion. When things get tough, when markets fall, when all correlations go to 1 and pretty much everything falls, businesses that have growing intrinsic values have some cushion underneath them. And that cushion is their strong fundamentals and that growing value over time. Businesses that don't have that safety net of strong fundamentals, the stocks can really fall a lot and sometimes really quickly. And so I'd like to believe that one of the most important services I provide is to try to identify businesses that I think have these growing intrinsic values. Doesn't mean the stocks are not going to fall. They will. Doesn't mean they're not going to fall a lot. But I think that over time, the stocks will eventually recover in most cases if I'm right about my assessment of the quality. Now, I will get my assessment of quality wrong. It has happened in the past. It will definitely happen in the future. I will make mistakes. But by focusing on the most quality businesses run by the best operators, I think I'm doing myself, because I'm invested in the portfolio, and my clients a service. Other thing about the management teams is when the going gets tough, when markets fall, or when the economy falls, or in a recession, the best management teams, that's when they really get to work. They don't let a good crisis go to waste. they will either, they will invest during the downturn to plant the seeds for rejuvenated growth coming out of that downturn. So what they do during that downturn, whether it's buying assets at distressed prices, or buying back their own stock at undervalued prices, whatever they do during that downturn really plants the seeds for hopefully accelerated growth, higher margins and higher returns on invested capital coming out of the cycle. Weak businesses that don't have these growing intrinsic values don't have the firepower, don't have the financial power to do that in a downturn. Strong businesses do. So they can invest counter-cyclically to use a downturn to their advantage. That's something else that I look for.
Okay. So when you say you can basically get rid of a company as a prospective investment within an hour, is that just do you start for defining a moat? Is that where you go first, or do you actually jump into the actual financials and the leadership team?
Yeah, so such a good
And,
question. It's one of my
and how would you define a moat? That's
yeah.
always